Hello, everybody. Welcome, welcome, welcome. It is Friday and we are in a brand new year. Welcome to Real World Recovery Financial Fundamentals 2025. Hope everybody had a safe and happy new year. I know I did. It was nice. We took it nice and easy. Spent the day. Actually, went to the arcade with a friend, so that was nice. And uh, then got to sit around and watch some TV and ate some food. Went to bed early, like an old person. I think we were in bed by 10 o'clock. But yeah, hope you all had a safe and enjoyable New Year's as well. Um, yeah, we're gonna do a kind of a split episode here. We got a little bonus part 3 from our investing basics. I'm gonna go over a couple of kind of advanced um, investing things here. Just little bonus stuff to add on top of the last 2 episodes. And then we're gonna do kind of a reset, refresher, and refocus for the new year, to kind of hope everybody can start off 2025 in good shape here and kind of have everybody get a good start into the year here. So we're gonna, like I say, start off by wrapping up the investing series here with just some practical tips, expanding out the portfolio beyond those tax advantaged accounts, how to make some smart choices about asset placement, exploring some alternatives, then shift gears into the new year refresher, give some tools to kick off 2025, have a solid game plan for the new year. So, yeah, get a little coffee, have a little vape, and then we'll jump right in. Okay, first, let's cover those advanced things we were talking about. So we talked about, the tax advantage accounts, 401ks, HSAs, Roth IRAs, things like that. So, and then we talked about some more in depth. We went into mutual funds, index funds, ETFs, stocks, both common and preferred stocks. Talked about ETFs, both active and passive. So now let's kind of dig in a little bit here into kind of managing some taxable accounts, how to diversify your portfolio, considering some other alternatives, and then discuss some practical steps to declutter, organize your finances, evaluate goals and systems, and start the new year off on the right foot. And as always, we'll wrap up with some actionable steps that you can take this week and into the new year. So, yeah, let's dive into the advanced side of the investing world and talk about how to build a foundation on what you have already started. If you have gone through the previous episodes here and kind of built up to this point. If you haven't, go back through. I highly recommend just going step by step here. Each week in the series so far, there's been steps that you can take. You can reach out to me in our Discord, follow us, reach out. There's tools and steps you can take. If you've got questions, hit me up. But please like, comment, subscribe, support the channel, share it with your friends. But yeah, once you have maxed out your contributions for your 401k, good job. That's awesome. Then also your Roth IRA, this last year and this year, I believe it's 7,000 is the maximum you can contribute to a Roth IRA. And then your HSA contributions, which is triple tax advantaged as well. What do you do then? So first of all, you're doing well on the income side, so that's great. For many people, it's a taxable brokerage account. No tax benefits, to speak of right off the top. So like that's not really the point of it, but it is an essential tool for growing your income and wealth beyond just tax advantages. Like that's not the only point of investing is to, save money on taxes. But that is the first place that you go because growing money and saving money on taxes, you're winning on both sides. So once you've maxed out that aspect, then grow your money as well. So choose a platform. That's obvious first step. Well, where am I going to choose to do this? So a couple of things you want to look for: low fees. Obviously, like why pay money to do your investing if you can get it for free or very cheap? There's plenty of places out there that offer low or no fees to set up a regular brokerage account. And if you're just starting off and just kind of getting the feel for it, it you don't need anything that's going to be expensive or cost you any money. I personally use Fidelity. Um, they don't pay me to say this, but I find it very easy to use. I know some people use E-Trade or Schwab, or there's plenty of them out there that it doesn't cost you anything to just set up a basic investing account, a basic brokerage account it's called. Um, Most of them are pretty easy to use. They've got some simple tools to um, do your research on different stocks and ETFs and things like that to get information. Um, One thing that I do like that you can find on most of them is the ability to buy fractional shares and do automatic investing. So this is something that helps with the systems that I've talked about before, as far as how we've put into place these automatic transfers and automatic purchases by being able to purchase fractional shares. So, not necessarily having to buy one full share of anything at a time allows you to say, okay, if I've only got, 10 or $20 going into my account because of the way I've got the automatic transfers and my percentages of my paycheck, it doesn't necessarily equate to being able to buy a full share of that index fund or that ETF or that stock. So being able to buy a half or a quarter or a tenth of a stock is advantageous, so you want to be able to buy those fractional shares and be able to buy them automatically and set those things up to happen automatically, whether it's once a month, twice a month, once a week, however your system works out. Having those things happen automatically and being able to set them up to buy fractional shares are super helpful. So having those automation tips, having those, recurring contributions, all of that helps with what we've been talking about with those systems and having it happen without having to think about it, without having it be an extra thing you have to do. So that's the couple of things to look for when choosing a platform for your brokerage account. Another thing to think about when you're thinking of broadening the different things you might want to invest in is tax efficiency, the different asset placement. So the difference between these tax advantaged accounts and a normal taxable investing account is the way that these investments are taxed. So there's things like index funds, ETFs are more tax friendly. So you still can think about how you'll be taxed on them. So index funds and ETFs, especially those passively managed ETFs, are more tax friendly because there's not as many transactions within them, so they don't generate as much capital gains. And there's tax inefficient assets. So these are things like REITs, REITs, those that stands for real estate investment trusts, or actively managed funds or ETFs, tend to be less tax efficient. So those would be better for those other accounts, your 401ks or your Roths or things like that, because they have more transactions happening within them and they generate more taxable events. So some things to consider is how often they will have taxable events happen within the fund. So stuff to consider, and these are all admittedly high end, high level things, and we don't have time in this episode to go too deep into this, but these are things to consider, and these are things I'm more than happy to get into bigger conversations with. So join me on Discord, reach out if this is stuff that interests you. Let's chat about it. I would love to have a longer conversation and get into the details of this stuff with you. So um, something to think about: a strong portfolio, it balances risk and reward. That's constantly the seesaw with investing. Stocks for growth, stocks, ETFs, they call them equities, stocks, ETFs, index funds, those things for growth. Bonds for stability, that's your anchor. And then your alternatives, those are the riskier things for diversification. So that's your REITs, the real estate investment trusts, even crypto, in small doses. That's the caveat. I always tell folks that are asking me about crypto, if it's okay to have some, but very very little. Don't, just because it's flashy and sexy and it gets all of the attention right now because of the big swings, it has no regulation. It's not tested. It could go all the way up. It could go all the way down to zero. There's no stability with it. So there's huge swings. So be very, very careful. So, I think it's fine to have some in the portfolio, but keep it very minimal as far as the percentage of your overall dollars invested, just in case. Maybe 5-10% of the total value of all of your investments, and I think you should be okay. And then, yeah, once you've got that core baseline of investments solid, 401k, IRAs, all of that stuff is maxed out or in good shape, then you can start building, your brokerage account, start building out, some of the more speculative assets, things like that. But remember, they can be exciting, but they're very risky. As you start getting into more of those alternative investments, that's more, as you add more risk, you do have the potential for more reward, but that's the game you play. So be very careful with it. So yeah, that's all I'll say with that for now. But reach out on Discord or wherever. Send me an email. Leave a comment down below on here. If you have questions, would love to connect. So let's recap on all of the stuff that we've gone over in all of the previous episodes, and let's really give ourselves a good foundation to start the year. So everybody has resolutions and things like that for the New Year's, and so why not revisit what we have done so far for our finances? Um, and let's reevaluate for our finances for this year. Um, think about for where we want to go starting today until January 1st, 2026. What do a goal is a good way of setting a direction. Um, but without having a system, without having a process, a goal doesn't really do much to actually get us there. So think about what we want to achieve, and um, we'll set some financial goals, and I recommend go back through and start from the first video in this series, and think about um, where do we want to get to, what are the things that we want to achieve financially, how did we do so far, where did we come up short, what do we need to improve on, what did we do well, um, and are our goals still aligned with our priorities, right? Like, what are the things that are important to us? And did we mesh? Did we stay in line with that, or do we need to make some adjustments? Um, how'd we do on debt repayment? Do we need to focus on that more, or did we do pretty good on getting our debts repaid? How do we do on investing? Do we need to, adjust that, or did we do well there? How's our savings? Did we have a pretty good cushion, or do we need to have a better, uh, short-term emergency fund? And then remember our budget, 50, 30, 20. How did we do on getting zeroing in and narrowing that down? Did we get close to that? Do we need to do some tweaking there? Do we need to trim a little, or did we do a good job trimming, and do we need to figure out a way to earn a little bit more? So the budget is that foundation, and once we have it, if we automate things right and we set our systems right, we don't need to keep scrutinizing over every little receipt. We can, set it, automate, forget it. And then when we're conscious about our spending, that's where we give ourselves permission to spend happily and freely on the things that get us closer to our goals. We don't have to, feel stingy and cheap all the time. We give ourselves permission to spend money on the things that we love and enjoy, and the things that don't align with our goals, that's easy to cut then. So, we just identify the areas there where we did well in conscious spending and spent in line with our values, figure out opportunities where we didn't do so well, and figure out, okay, these are the areas that we gotta, adjust, and um, we can look back through and do a little bit of take a little bit of an inventory of how we did, and then we'll declutter. Things get messy, so take an opportunity to sit down, and we're doing our taxes and stuff anyway at the beginning of the year. We start getting those W-2s, so it's a good time, as long as we're doing that stuff anyway, to start looking through how we did on our spending, and income versus outcome versus expenses, and start to kind of just take a look and get a big picture, see how we did. It's a good time to do that anyway, since we're looking over our taxes and stuff anyhow. It's a good time to see maybe there's some subscriptions to things that we're not really using that we can cut out, things like that. Maybe there's some debts that we're paying on that maybe we can renegotiate and get a uh, better rate on. Maybe we've improved our credit and we can refinance a car loan, or we can refinance a personal loan or something and get a better interest rate on, because we've improved our credit score and lowered our credit utilization and things like that, and we can get better there. Maybe we've pulled our credit report, from all of the bureaus, and we've found a few things that we can dispute and get some things knocked off of our credit report this year. So there are a number of things that we can do at this time of year, and being the new year, we can pull our credit report again. You can do that once per year at annualcreditreport.com, which we went over in episode 3, uh, the Breaking Free from Debt and Repairing Credit episode, if you want to go back and check that out. So, and then, one of the biggest things to reinforce all of these new habits is celebrate the little wins. It's all too often we don't celebrate the victories, the little ones. We put off celebrating until that big victory way down the road. So it's hard to get in the good habits early, because the bad habits give us that early payoff. And so that tells our brain that we want to keep doing that because we get that instant gratification. So if we make those bad habits harder to do, and we make the good habits easier to do and get an easier, even if it's just a little payoff early, whatever that might be, it can help us reinforce doing those good things over and over. So let's, all commit to doing one or two good things for ourselves here. Just to go back through and take this time at the end of the year, or at the beginning of the year, I suppose it is, while we're kind of all looking over everything anyway, to take a little assessment and take a little inventory of everything, and be able to kind of see where we succeeded and where we've got an opportunity to do better. And I highly encourage you to go through and take a look through the different you know episodes in the past here that we went through leading up to this, to kind of get our systems in place if you didn't get a chance to get through them, and get ourselves set up with some systems to automate the process of zeroing in on our budget, figuring out which accounts we need to have set up, focus on where we need to do the work, whether it's getting out of debt, whether it's repairing credit, whether it's having ourselves zeroed in on a budget, and then automating it, setting up as many systems as we can to make sure that the money automatically gets where it needs to go, the bills automatically get paid when they need to, and the money that's left in our fun account, that is there for us to spend guilt-free on the things that align with our values and what brings us joy and where we want to get to. And I assure you that this whole year will feel so much less stressful, and we will have such a better financial foothold for the entire year, that then by the end of 2025, and when we're talking about this in the beginning of 2026, everybody's going to be looking at this like, oh man, we're in such better shape just from doing a little bit of work at the beginning of the year and letting it do its thing for the whole year. That was fun. Hi, robot, and welcome back. My camera. It's got a mind of its own sometimes. So yeah, what we want to do, basically, to recap, we went over some of the advanced stuff that is kind of above and beyond. And if you do have questions about any of the investing strategies from today or the last two, please reach out. I don't want to get too deep into specifics of investment strategies or portfolios or anything with this channel. That's not really what I want to do here. I want this to stay focused on fundamentals and foundational financial basics. So but please reach out if you ever want to connect. I'm happy to have some one-on-ones and or get into it on the Discord, and we can get into more of that specifics there. But yeah, you know, we talked about some of that stuff and how to diversify, and all of that, and then we talked about going back through and taking a look at the starting the new year with a clean financial slate, and kind of doing an inventory and assessment, and reevaluating, and making a plan, and setting a target, but then focusing on the system and the process and how we're going to get there. So it's not about perfection, like everything else in recovery. It's about those small, consistent steps, and making that progress. So here's what I would like to see this week. Go through your portfolio, um, see if you're ready to expand beyond those tax advantage accounts. If you are, then you know open a brokerage account. Um, if you're not, then stay focused on the accounts that you've got, and um, at least think about the balance that you have. Whether if you need to adjust it all for the new year. Write down your top two to three financial goals for 2025. That's going to set a target for where we want to get to. And then one action, just one simple action, that's going to get you a step closer towards that goal, that you can do, whether it's automating, um, you know, uh, savings increase, or checking your credit bureaus, or um, trying to get a better rate on a personal loan, or whatever it is. But one simple action that you can do to get you a little closer to those goals. And then next time, what we're going to do, we are going to talk about financial resilience, how to be prepared, and have some tools handy for unexpected challenges, and be able to stay on track, so that you can bounce back or be prepared for any kind of challenges that come your way. But yeah, until then, yeah, remember that recovery and finances, it's all about progress, not perfection. So till then, we'll see you next time. Stay on track, and give me a like, subscribe, share me with your friends. See you on Discord. Bye.